Ladies and gentlemen, welcome to the Business Brew. I'm your host, Bill Brewster. I'm here with Moses Kagan this week. Moses is a real estate investor and a GP in a real estate fund, I believe, right?
That's right, yeah.
Sure. Yep.
Among other things, yeah.
He's got an interesting way of looking at the world. I love his Twitter feed. I love the interviews that I've heard of him. He talks about the intersection of value investing and real estate. It's pretty fun. So I hope you all enjoy. As a reminder, this is not financial advice. We're not your investment advisors. We're not your advisors, fiduciaries, etc. Do your own due diligence. This is entertainment purposes only, folks. So with that out of the way, Moses, how you doing, man?
I'm pretty well. It's raining today in Los Angeles, which is pretty unusual. So it's a little bit of a downer, but otherwise I'm good.
The nice thing about that is we won't even need to timestamp this because people will just be able to go back and say, well, when was it raining in LA?
Exactly. I think it's literally like the second time in 12 months or something like that.
Not so in Florida. We get plenty of it here, but that's okay. So to give a little bit of your background, you want to just sort of fill people in on where you're at in your career like now, or do you want to start at the beginning? How would you like to go?
Maybe start with where we are now, and then if you want to go back and delve into the how we got here, I'm happy to do that.
Yeah.
So I am a founder and one of the partners at Adaptive Realty. We are a boutique real estate private equity firm. We are sort of laser focused on sub-institutional scale multifamily. So these are deals that are they're tiny. They're between like 3 and 10 million total capitalization. And one of the things that makes us pretty unusual in the real estate private equity world is that instead of buying buildings, fixing them up, and then flipping them and sort of being like IRR driven, instead we buy buildings, fix them up, refinance them to return capital to our capital partners, and then hold the buildings with our capital partners more or less permanently. It's a really weird kind of way of organizing a real estate private equity firm, but I'm sure we'll get into the rationale and everything. But that's us. We focus on a relatively small number of neighborhoods. We're vertically integrated. We do all of our own construction management, and we have a property management firm as well. So we manage our own buildings. We just keep turning the crank, basically doing the same deal over and over and over again for, at Adaptive 8 years, and it's 12 years overall.
That's cool. So how'd you get into it?
By accident.
Well, that's how most things in life that are good happen, I feel like.
Yeah. I mean, we can go through the whole story. I think the first thing to say is it was not planned. My family had somewhat of a real estate background. My parents always owned like a few tiny buildings in upstate New York where I'm from. So it wasn't...
Where in upstate New York?
Troy, which is near Albany.
Oh, yeah, I know Troy.
Oh, yeah?
Yeah, man. I go to Manchester, Vermont. That's where I spent my summers as a kid.
Yeah. So you kind of drove by.
That's right. My
father was a professor of art at Rensselaer Polytechnic Institute, which is there. And my mom was a state worker in Albany. So anyway, that's where I grew up. And by the way, when I was a kid, real estate in Troy was basically free. My dad literally...
I think it still might be, to be honest.
It's actually experienced like somewhat of a surprising resurgence. Like a lot of people got priced out of New York and moved up to Troy because it's actually kind of a charming city. Or at least it has charming real estate. The city itself was pretty run down when I was living there. Like my dad still owns a building that he literally got for free. Like the city was just like, oh yeah, the city it's this beautiful yellow glazed brick industrial building, like really gorgeous. Huh. And the city basically was like, if you pay the property taxes, we'll just give you the building. So
really?
Yeah. Anyway, so we always had like a little bit of a background.
Hang on, wait, we're not going on. So did you grow up there in Troy?
Yeah. So I was born in New York City. My dad was on sabbatical. My parents were living in Tribeca. And then when the sabbatical ended, they moved back to Troy. And we lived in a series of these really cool old turn of the century brownstone buildings. And my parents would sort of buy a building. We would live in one of the apartments. They'd rent out the other ones. And then they would we'd move, but they would keep the original building and buy another one. It was really like... It's like immigrant real estate stuff, like, just like not professional. They self-managed. I mean, know how one would go about calculating IRR or thinking about leverage.
Street smart stuff.
Yeah, totally. It's just like, do the rents minus what we think the expenses are going to be exceed the mortgage? Okay, like let's do,
Were they immigrants?
My dad is. My dad was born in a refugee camp in Germany right after the war. His parents were Holocaust survivors. And then he grew up mainly in Israel and then came to the United States when he was about 13 or so. So he doesn't speak with an accent, but he speaks Hebrew and Yiddish reasonably well. And my mom was born in the United States. But my family, for whatever reason, her grandfather came from Russia when he was 15 in 1910. And my family has like a real sense of like valuing immigrants. Even though my mom's side of the family, like she's, I guess, second generation born in the United States, she still thinks of herself as like very connected to great grandpa Morris, who like came here on a boat by himself.
Yeah.
I think we've done a good job in our family of sort of preserving that immigrant mentality. And we'll see, I have 3 sons that are getting raised in a pretty privileged Los Angeles kind of a way. And it's going to be interesting to see whether we can kind of perpetuate that immigrant feeling with them.
You probably lose a little bit of it.
I think that's right.
But, try to keep them grounded. My wife is first generation. So her dad came from Poland. I mean, similar, their stories after the war were crazy.
Yep.
They're not Jews, but I mean, what they saw and really like just how they were treated by the Russians.
Oh, yeah.
It's not great stories that I hear, but it's been amazing for me to talk to my father-in-law about what it's like to come to the country and not know how to speak English, right? And like how to scrape by and try to make things work.
Yeah.
I'm really grateful it's in my life. It's given me a peek into a different part of the world that I otherwise would have been blind to.
No, it's absolutely. And I mean, one of the cool things about real estate in Los Angeles is that I don't know if it's majority immigrant, but it is to a very large extent kind of an immigrant business.
Really?
Oh, yeah.
The owners
of?
Oh, yeah,
owners. Yeah,
really?
It's like, and all different nationalities. I mean, there's a lot of Persian Jews, plenty of like Chinese owners and Korean owners. And it's awesome.
I mean, do you have any hypothesis as to why that is?
Yeah, there's a couple things going on. One is, and actually kind of, it's interesting. There's an interesting intersection with why our business exists. One thing to say is that Los Angeles zoning is really like pretty suburban in a lot of ways, except for in a few neighborhoods. There are not the kind of like huge buildings that you'd find in New York, like, 200 unit, whatever.
Yeah.
Okay.
Sure.
So it's
because those are all like downtown, right?
Yeah. There's some of that downtown and like increasingly in Hollywood and stuff, but like, your standard kind of Los Angeles apartment building is like 4 units built in like 1924. So those are manageable size for like a family to save money and just buy their first 4-plex and they buy another one. And so it's like there's an easy rung onto the ladder that immigrants find that they can sort of seize. And of course, like the ambitious ones and the smart ones kind of end up owning bigger and bigger stuff, but there's an entry point that's relatively accessible.
My father-in-law is much more willing to take a risk on real estate as opposed to like the stock market too. I wonder if that has something to do with just sort of the historical.
Oh, look, there's
how it all works.
I think there's a lot of these people are coming from countries, whether it's Jews from Europe or Chinese people coming from China. They're coming from places where like you literally weren't allowed to own land. And so the idea that you can like come to a city and like permanently own land is just like, everyone's like, are you kidding me? Like, let's do this.
That's interesting.
Yeah. So the community here is very scrappy. The other thing to say, and this is maybe another interesting sort of intersection with real estate more broadly, is that real estate was not an institutional asset class until I think like the late 90s. So the people who before that, it was just a bunch of like weird families, and there wasn't the internet and books and bigger pockets and all these things that sort of transmit real estate knowledge to normal people now. It was like a weird niche skill set that people kind of developed on the side, and the buildings were cheaper and the returns were much higher because there was much less capital floating around in the asset class. So it's just like the biggest private landowner in Los Angeles is a Korean dentist. He just started syndicating buildings after the Rodney King riots and just like kept going.
That's pretty smart. That's a good example of one foot in front of the other and some compound growth, right?
Totally. Yeah, no, I mean, it's funny. I was on a panel with his daughter. She just said like he just was looking around after the riots in Koreatown. It was just like they were selling skyscrapers, not like huge skyscrapers, but like, 12-story buildings or something. And I can't remember what the price per square foot was, but it was like $20 a square foot, just like so far below the cost of building that building. Like I think he had his dentist office in one of them, and he bought the building that his dentist office was in. And then it was like, this is a good business. And then just started buying all of them.
That's smart.
Yeah. I mean, just the guy's an incredible human being.
Yeah, I wish that I had listened to Bigger Pockets when I was younger. I did house hack my first house that I had, and that was the first time that I sort of like saw the power of just basic real estate concepts, right? I mean, it sounds so silly now to say, but when I was younger, I mean, I was like, well, I kind of, should I rent? Should I not? And then I was fortunate to have some capital, so I put the down payment. My buddies lived with me. Then all of a sudden it's like, oh,
yeah,
a lot can actually go wrong in the price, but the cash flow sort of can bail you out.
Oh yeah,
no,
no. I mean, if you use, if you pay like a somewhat reasonable price and you use a somewhat reasonable amount of leverage, and you're in a decent area, like it's probably going to go pretty well.
Yeah. That's interesting. So how'd you get your first building?
So this is
not like syndicated. I'm talking about like, how do you get started in the business?
Yeah, and this is like one of those like privilege alert moments. So back to my great grandpa Morris from Russia, he ended up amassing a reasonable portfolio, which he kind of lost over time. But anyway, he died with one building remaining in the 80s. It's the building where Moe's Caribbean, which was like a bar that people used to go to.
I know Moe's.
Yeah, Moe's Caribbean. So that building, my great grandfather owned.
On what, like 70
something,
third and third or something like that? Yeah, my stepbrother's part of that restaurant group.
Yeah, okay. You know what? Actually, that group, I believe, ended up buying the building from my family.
Oh, wow.
Yeah.
What a small world.
Yeah. So this is like in probably 2006. And it wasn't because that was actually a great time to sell, but it wasn't because we were prescient or anything. It was just my great-grandfather had died and there was 3 children and grandchildren and great-grandchildren, and parts of the family needed money more than maybe my part of the family did. So anyway, so we sold, and the money went from my great-grandfather's estate to my grandfather, who handed it to his 2 children. So my mother got a chunk of cash from this building that my great-grandfather had probably bought in the 60s or I don't know when. And then at the same time, my brother and I were looking, this is like 2006, 2007, my brother and I were looking for a duplex to buy to just live in. This is like during the real estate mania, right? Like everyone's like, oh, okay.
Yeah, like 07.
Yeah, exactly.
Like right. No doc loans, all that stuff.
Yeah, exactly. And like the prices were insane and we realized they were insane. But my brother found a guy who had renovated a derelict 16-unit building in a kind of a cool neighborhood or adjacent to a cool neighborhood and run out of money before he could finish it and rent it up.
Nice.
And so we were able to strike a deal to buy that building from him at a price that was kind of reasonable. And the capital for that acquisition, the first deal that I ever did, came from Grandpa Morris's building by way of his son and then his daughter and then to my brother and me. I mean, I think it's like such a cool story that like this guy came to America and all these generations later, like my career was effectively like kicked off by capital that he formed.
That's awesome.
Yeah.
And I assume he's not around anymore.
No,
Is that accurate?
He was,
so
he'd be like 100.
He's probably looking down happy,
Or up.
If you believe in that. Yeah, either way, right?
Morris was, I loved him. I mean, he was a sharp dude, but he was not a nice man. To come here when you're 15 and not speak the language and not have any money and like claw your way to success the way that he did required a certain kind of backbone. He was just like a domineering, tough man. And, he was really hard on a lot of people in the family and everything. By the time I knew him, he was like almost 100 and he was, but he had calmed down somewhat, but he was a tough dude. Yeah. But I mean, look, that personality basically enabled a whole family to exist in the United States and thrive and everything. And, obviously I'm eternally grateful for that.
Yeah, that's wild. My story is not all that dissimilar, a little bit different. Most of what has enabled my life is based on insurance money. But the other side of the family was in construction in New Jersey. And everybody always jokes like, oh, you must have been part of the mob. I don't know. They went bankrupt on a large project. And I do sort of wonder, like, did they cross the wrong people? But I don't know. And we're not in it. So
I think in that period, like, I don't know if it was tough to do business without, dealing with those guys in New York.
That's sort of what people say. I don't know. It was a long time ago. I'm not doing it myself. So whatever.
No, fair enough. Listen, I'm interested in the entertainment business, like just intellectually interested. And so you read about these old studios and everything, and just like all the money for everything was coming. Like organized crime was so wrapped around the economy in the 50s and 60s and even into the 70s that like basically every major business had some cross paths with those guys at some point.
Yeah, and we did big construction projects like the on-ramps to the Lincoln Tunnel, I guess. And
Yeah.
like stuff that,
Yeah.
I mean, it was government work, so who knows?
Oh,
I don't
yeah.
ask too many questions. I don't really care about it.
No, it's interesting.
Huh. I've wanted to get into real estate. For some reason, I have this sickness where I love the stock market, but the problem that I have with the stock market is it's not a very good cash flow game and it's not very tax advantaged. So I'm always wondering to myself, why the hell don't I have a duplex or a fourplex or six or whatever just to get started, right?
What I always tell people, so you can imagine, I talk to prospective investors a lot, and many of them are in the situation of like they've got extra cash, obviously, and they're kind of wrestling with whether they should invest with me or someone like me or just go buy their own building. And I think it's perfectly reasonable to go buy your own building. I think that the choice probably comes down to like how you, or really how the market values your time. So like if you're extraordinarily well compensated in your job, if you're a partner at a law firm or whatever, it's like, do you really want to spare the time to go deal with buying an 8-unit building?
Yeah.
Probably not.
Probably doesn't make sense.
Yeah. But if you're like an immigrant hustler or just a hustler and you got some extra money and you know, owning your own stuff, it's a little bit of a pain in the ass in the beginning. But once you find like a good management company and you kind of dial it in, it's not totally passive, but it's not rocket science.
Yeah. The podcast game is not paying the bills yet, but we'll see. So, all right. So you have your first building and what happened? So you had 16 units and did you have to finish renovating it then?
We did. I like the in-depth questions because I've talked about the story before, but there's so much interesting stuff that happened just in that one building. So, okay. So,
I'm sure it started your whole career.
So we bought the building. We needed to do some renovations, but we actually hired a guy who was on my brother's soccer team to do like some of the work. And like, he kind of overcharged us, but we didn't know what we were doing. So he started finishing the work, but we still have a vacant building. We have a mortgage payment coming up. And so the bank had forced us to hire a management company because we didn't know what we were doing. The bank that loaned us the money was like, you need to hire this management company. And they were okay. They weren't the world's greatest management company. They were fine, but they had this leasing guy. And the leasing guy starts trying to lease the building. And we're just like letting him do it because we're like, this guy's the expert. And this guy, like, honestly, he had like weird, like, he was just like had like a creepy vibe around him. I don't know. It's just like not someone who you would want to rent an apartment from. So I'm looking at this guy.
And you're forced to use them.
Just, yeah, well, we're right. And I'm just like, I mean, I get this guy's an expert. I get, you know, the company's using him. He must be, but like, he seems really creepy. So he starts leasing the apartments very slowly. And by the way, that realization that you shouldn't have creepy leasing agents, like no shit. And like that, like people are like, how come you guys are good at leasing like in our business now? And it's like, well, we like pay attention to who we hire as leasing agents and we try not to make them creepy. Like it's like not
That's a good first step.
Anyway, so he starts trying to lease the building, but he's going slowly. And okay, a couple of things happen. One is the second person he brings to us. So he leases one unit. I think the second unit he comes to us and he's like, this woman wants to rent the apartment, but she doesn't have papers. She's here illegally. And we're like, we want to rent the units. And also like, you know, we're like, we want to do a solid for someone. So she seemed like a nice person. So we're like, okay, look, let's let her rent the apartment. Big mistake. So her boyfriend, who she like he never like put in an application or whatever. Her boyfriend turns out to be this like real lowlife who it turns out she goes to work every day and the boyfriend is running prostitutes out of the apartment.
Oh no.
So this is our second tenant.
Yeah.
Like,
that's tough. And you don't even get a cut of the pimping.
It was just like really, and Los Angeles has these really strict, like it's hard to evict tenants in Los Angeles. Like even if they're like obviously running prostitutes out of your building, you're still going to take 90 days at an absolute minimum. That was back then. Now, I mean, it's even longer. So I'm like freaking out.
Really? So you can't even go to somebody and say like, this guy's got a prostitution ring. Can I get him out of here? They won't let you.
I mean,
I guess I understand who they're trying to protect, but that's silly.
Yeah. And I'm freaking out. I'm like, how are we going to get this guy out of here? We got to get a lawyer. And my brother, who is 18 months younger than I am, was like, let's go talk to him. And we just went. And my brother, my brother's like kind of he's bigger than me. And he's like, my brother's like a pretty forceful personality. And my brother was just like, hey dude, like no harm, no foul, but you got to get out of our building. He wasn't like, we're going to get a lawyer. My brother was just like, look, we own this building and you can't do this here and you need to leave. And the guy actually left. It was kind of amazing.
Huh. Good.
Yeah, it was pretty cool action for my brother. So anyway, so that was like experience one with the tenants. Then the next,
that was tenant two.
so then we're like, oh, we got to fill this building up. And there is a home across the way for teenage mothers. And it's a wonderful charity. They take in teenage girls who have got pregnant, whose parents kicked them out. And they like provide services and they help them finish school. And anyway, so I went and talked to them, and it turned out that they needed places to put the girls who were kind of or women who were graduating from the program at 18 or whatever. They wanted to expand to continue providing services to those women.
Yeah.
So after they kind of leave the campus of the charity, they're going to help them find an apartment. And we were like, look, we've got these apartments. We're right across the street. So we made a deal to rent, I can't remember if it was 4 or 8 of the 16 units to graduates of this program, which was great because the charity basically co-signed, effectively guaranteed the leases. So it was like, okay, well, we've just filled up half our building in one deal.
That's awesome. That's a win-win.
Except
sort of. Except
the women themselves, I keep calling them girls because they were like 17, 18. They were mothers. It was like a weird situation. They were not very particularly mature, but they were nice enough. The problem is that when you put a bunch of 17 and 18-year-old women in a building, they attract a certain kind of guy. And so meanwhile, we're renting the other units that they're not occupying. So we kind of have a mix of these women and then we have these other tenants. But the guys that the women are attracting are like hanging out in the hallway and like, it's just again, like disaster. So we basically over time, we sort of wound that program down. They eventually left and we filled units with kind of like more conventional tenants. But it was like such an object lesson in how important tenant selection is. It's just like
how long did it take you to wind through all these tenants?
It probably took like a year and a half from when we struck that deal. They moved in and then slowly they moved out and we replaced them with regular tenants. Again, they weren't bad and they paid the rent. So on one hand, like that's good, but it just, one thing to say, this is like,
dude, I'm laughing. I'm just thinking about your first real estate.
Oh my
experience.
God. It was in my, we didn't want to tell our parents. And it was just like, it was terrible. It was terrible. And in fact,
I'm basically housing pimps and young women that are a little bit lost.
I actually lived in the building for a little while in one of the apartments. It was just pandemonium in there. It was just we got to fix this. And this is an interesting kind of lesson. I actually haven't talked about this on a podcast either. If you're going to run nice buildings in kind of semi-marginal neighborhoods, right? People will put up with a lot from the surrounding neighborhood. Okay. What they will not put up with is misbehavior inside their building.
Yep. That makes perfect sense, man. Because that's like their sanctuary, right?
Yes. So you gotta things can be rough around the edges, but you can't allow it into the building. You have to make sure that, because one bad tenant, forget about having more than one, but even one bad tenant can ruin the whole vibe inside the building, make it feel unsafe and uncomfortable for people. And it immediately changes the dynamics in the building, and it changes the kind of tenants that you're going to get to move in subsequently. So it's, to this day, we manage 700 units now, half of which we own.
Wow. Good for you, man.
Half of which we own, half of which we manage for third parties. And to this day, I personally approve all of the tenants who move into all of those buildings.
Wow. Cool.
It's because one bad apple can ruin an entire building. And then you're talking about, they're not huge assets, but it's like a $5 million building and you're going to let some jerk in and he ruins it for everyone else. It's just, you can't tolerate that. So, So I've kept control of that.
I'm just thinking I was part of it was only like a 9-unit condo association, but it's somewhat similar. If you get like one person in your association that like either bitches about all the repairs or whatever, like things just become a pain that don't have to be.
Yep. No, it's, you're living in a little community with people in a multifamily dwelling. It's just like, you can't have people who, I got all kinds of stories about misbehavior. Even tenants who we approved and we thought they were good. It's like we get phone calls. It's like the tenant in unit A is pissing off of his front balcony every night. And you're just like, dude, like you live in a building with other people. Like, why are you doing that? You know what I mean? Yeah. But anyway, you do what you can to try to make sure that kind of stuff doesn't happen.
Huh. That's interesting. How many of your buildings starting out were in like, and I mean, even now, were in like neighborhoods in transition?
Pretty much all of them. I mean, all of them. Yeah. I mean, some of them are like more in transition and some of them are sort of like, it's kind of like a curve, right? And like, we will buy at various points along that curve. So sometimes we're buying neighborhoods that are like mostly transitioned and still a little rough around the edges. And sometimes it's like they're considerably rougher and just starting to transition. And it's like, it's a risk reward calculus and it comes down to like where the numbers work and where they don't. It's hard for us. We've never bought a building, for example, like on the west side. The west side of LA is like, it's gorgeous. You're near the beach. There's tons of jobs. But it's like
the cap rates just don't work.
Yeah, it just doesn't. The numbers don't make sense. And like, God bless the people who can make those numbers work. Because like there are people in the real estate private equity business who can raise capital cheaply enough.
Yeah, their cost of funds is just cheap enough.
Exactly. And you know, like my hat is off to them. So far, our investors have sort of required higher returns, and those returns are more available in kind of transitional neighborhoods.
Yeah. When I was in Chicago for my Chicago peeps, it's Division and Clybourne is what I'm talking about. I bought the first house that I actually did pretty okay on. I didn't sell it to do okay, but I collected the rent. Me and my buddies were like, oh, we can live near Cabrini Green. Like, that's not a problem at all. And my bedroom looked at 3 towers, and my neighbor had 2 bullets go through his window. We were on the 3rd floor, so I was always like, well, if a bullet comes through, at least
it's going to be slanted up,
like,
right?
Yeah, it's not going to like hit me. But man, I'll tell you what, when my wife and I sold, she was like 5 months pregnant. Somebody was smoking crack on our front steps. She was like, I'm not having a baby here. In retrospect, it sounds ridiculous, but it's all true. When we sold, we moved somewhere in Lincoln Park, and the people that closed like that week were walking their dog, and a bullet came into the lobby.
Oh my God.
But those were the only 2 bullets that ever, came into the building in like 5 years or so. But this is all relevant because the question I was going to ask is, when I bought it, I thought like, well, this neighborhood is obviously going to change. Like, there's no way that it can't. I had this panoramic view of the city. It was sick. Like, the rooftop was awesome. Then I found out my alderman was different from the alderman across the street. And the incentives politically, there was no way the neighborhood was ever going to change. And I didn't really understand how local politics in Chicago worked when I bought the building or the unit. How do you sort of, I guess, avoid maybe some of the issue that I'm talking about, or pick like which neighborhood to sort of bet on to transition?
Yeah. It's a really interesting question. First of all, I would say that we are very selective about which neighborhoods we go into. We're like, and we can talk more about this in a minute if you want, like we're very, very quantitatively driven in terms of evaluating prospective acquisition targets. And so by far the most important factor is what rents we can forecast for renovated product. We can go through why that is, but basically like
let's go through why it is.
So we're totally driven by unlevered yield on cost. And it's just like an incredibly simple calculation. It's basically a cap rate, but like because we're doing work to the building, it's not. So a cap rate, for everyone who doesn't know, is so you take your rents, your annual rents, and you subtract your annual operating expenses, not including a mortgage. So just like your property taxes and trash pickup and lawn and all that stuff. Okay. And that resulting number, rents minus annual expenses, is your net operating income. Okay. That's just the unlevered cash flow that's coming out of the building. So to get a cap rate, you just divide it by the purchase price. Okay. And that number will be like 5% if it's a 5 cap, or it'll be 7% if it's a 7 cap. And the concept is that if you invest $1 million, you'll in a 7 cap building, you ought to get, with no mortgage, you ought to get $70,000 a year in net operating income. For us, the equation is very similar, except that we're not just buying the building, we're also renovating it. So it's forecast net operating income on the top in the numerator, and the denominator is the cost of buying the building and the cost of fixing it up.
Yeah.
Okay. So unlevered yield on cost is just like, what is the net operating income we're going to get every year after investing X amount of cash into the building, ignoring a mortgage? So that's far and away the thing that we focus on most when we're looking at deals. And
can I stop you real quick?
Yeah.
So I just like thinking through how this could work. I could see the math getting you into some hairy situations. You ever get into neighborhoods that you like don't want to drive into?
It's interesting. It's a good point. In general, the way that Los Angeles works anyway is that if you take a realistic view of the operating expenses and a realistic view of the rents that you can get, it is unlikely to make sense to go into really terrible neighborhoods.
Huh. That's interesting.
Well,
why is that?
Well, one thing is, and this is like, it blows me away that people run slum buildings in Los Angeles, because even forgetting about the eviction moratorium currently, even like in normal times, it's extremely expensive and time consuming to evict a tenant.
Yeah, that's what I can't believe I forgot.
So if you have a tenant who misbehaves, it's going to take 3, 4, 5 months to evict them, and it's going to cost you. They'll ask. They can get a jury trial.
Yeah,
and which is going to cost you
Chicago.
$20,000. So one unit or a couple units doing that every year, it destroys your cash flow. Both because you're not collecting any rent from those units, and you're having to spend money on legal fees and maybe a settlement or whatever to get it over with. So it's like, if you're just looking at like a broker package and you're like, oh, this, it might make sense to invest in like a crummy building in a crummy neighborhood. Once you've like have some scars from that, you realize that those broker numbers don't take into account like how many eviction cases you have to file and how many months of rent you lose and buildings you have to fix because the tenant broke it and that kind of stuff.
Yeah. Huh. How many buildings did you have to live with that on before you realized I don't like these numbers?
Well, it's funny. We do not want to run buildings like that.
Yeah. No, it's clear why.
But one of the things that we did early on, it was a mistake from a capital allocation perspective, but it worked out really well. Our biggest investor in Fund 1 in Adaptive came to us and was like, in like 2013, and we're like, we're doing really well buying single family homes in like Phoenix and Chicago. Why don't you guys just take a bunch of money from us and go buy a bunch of single family homes? And I stupidly was like, no, I've got this other idea. And my other idea, and it's like when someone that rich, who's that experienced, comes to you and is like, you should do this strategy and I will capitalize it. You should say yes to that person, not no. So I was like, no, instead what I want to do is buy a bunch of junky buildings in this like fairly rough neighborhood. And the thought process was the neighborhood is, and I don't actually want to say the neighborhood because it's a little bit politically sensitive, but
yeah, that's fine.
The neighborhood is so clearly well positioned for like future growth. So I absolutely categorically certain that the neighborhood would improve. And the prices were so cheap. Like I was able to buy buildings for like $100 a square foot in a central neighborhood in Los Angeles. It was like a no-brainer. But the idea was that we were going to buy these buildings and kind of sit on them for a while before renovating them. Just like run them as is before going through the process of renovating them. So we did that. We bought a portfolio of these buildings and then we hired another management company to run them. But I just had to like watch, and just like every month we'd look at the financials and it's like, oh, this so-and-so stopped paying rent. We're in eviction with that guy. Like, oh, this crappy old building has another plumbing leak. Up, surprise, like $7,000 that wasn't in the pro forma to fix the it really drove home to me that I just do not want to be in the business of owning a bunch of rundown buildings with tenants who maybe are not the most responsible people in the world. Like someone needs to do that. It's just not going to be me. That's just not a good business for us to be in. So I learned that lesson. And eventually we ended up renovating those buildings and it's done very well, but not as well as it would have been to just go buy a bunch of single family homes.
Yeah. Well, and your return on time is lacking.
Yeah.
So you get done with that project. First of all, I got to take a little bit of a step back because you said he was an investor in Fund 1. So you had already raised a fund?
No. So let me go back and give you the actual chronology for the business. So my brother and I bought that first building. The real estate market collapsed. Like this is now 2000. I think we closed on that building in like very early 2008. Real estate market immediately collapses, but we've done a good enough deal on that building. It turns out okay. Like cash flow got a little thin there for a little while and rents came down. It was pretty painful, but like the building was fine.
Yeah.
Meanwhile, real estate goes on sale. And I have a buddy, one of my best friends at that time was like making an absolute fortune in a hedge fund that he had started. And he needed somewhere to put the capital because you probably remember, like if you were making a fortune in 2008 and 9, which bank do you put it in?
Yeah.
Right. Like,
you're scared of them all.
Yeah, exactly. I mean, even Goldman Sachs had to go get like basically support, whatever it was called. They were designated a bank and everything. Every one of them was in trouble. So we went to this guy. We had an opportunity to buy another building from the same management company that the bank had forced us to use on our first deal. It was really cheap. They came to me with a price and I said, no, even a much lower price. And they were like, okay. And I was like, the guy was desperate to sell and no one was buying. We're the only idiots who were like interested in buying stuff. This is like 2008, 9. Everyone else is like falling knife, don't catch it. And we're like, this looks pretty good. Like this is a neighborhood we really like. And the building was $75,000 per apartment in Silver Lake, which like for anyone who knows, even crappy units.
Below replacement cost.
Oh my, replacement cost in Silver Lake right now is probably like $500,000 a unit. Yeah.
Wow.
Yeah. It's
all because that creepy salesperson leased up a weird building and they had to sell in 09. Did they have too much debt or something? What was going on?
The guy who we bought it from was a syndicator. So he had been going out and doing a bunch of syndicated deals all the way through the run up. So like 2005 and 6 and 7. I think he had like cross collateralized things and like it was just like a friggin' disaster and he just needed to get out of it immediately.
Oh man, good for you.
Yeah, well, so I went to my buddy and was like, look, this building seems cheap. And he is like sitting on a load of cash. And I don't know if you remember also, everyone was expecting massive inflation, right?
I do remember gold ran like crazy. People wouldn't stop talking about gold.
Right. And so that was like, everyone's like, well, the Fed's printing money, like there's going to be crazy inflation. So everyone's like, okay, well, conventional wisdom was go own hard assets, right? Yeah. So from his perspective, even though we didn't have very much experience, he knew he could trust us as like we'd been friends forever. And we were just going to buy hard assets. So like he was like apartment buildings in Los Angeles are probably not a crazy thing to do with money right now, particularly if we're going to have a bunch of inflation. So he was willing to trust us to buy a building and we did. And we started kind of executing the business plan of fixing it up and it worked. And then he backed us to buy a whole bunch more buildings very quickly. So like between like 2009 and 11, I think we bought deals like 2 through 13 or something like that. Just like really quickly, like way faster than you would ordinarily be able to do that in a normal real estate career.
Wow.
It's just dumb luck. Like a great friend who's a genius who got super successful and was willing to trust me.
That's wild. I had talked about our insurance company, the families, a little while ago. When I talked to my grandma about where the inflection point in that insurance company really came was the Great Depression.
Really?
Yeah, people were afraid to underwrite. And my, I guess he's great-grandfather and his business partner just like went ham and they just captured like a ton of market share.
Yeah. I mean, for us, I think a big part of why we were able to do that is we were so naive. First of all, a lot of professional investors were at that time like dealing with problems in their own portfolios. They had bought stuff in 2005, 6, and then these things are getting foreclosed on and they're underwater and they're doing workouts and it's a disaster. So a lot of the professionals were kind of like on the sidelines for that reason. And even the ones who had access to capital and could have bought, most of them had lived through the savings and loan meltdown and the RTC in the mid 90s when real estate got stupidly cheap. Like, they were giving it away. And so in 2008, 9, 10, those guys kept waiting for the same thing to happen, for the banks to capitulate and just blow out the commercial real estate. But the crucial difference this time was that the Fed stepped in and basically allowed the banks to extend and pretend the loans. To protect the banks, they basically made it so that the banks didn't have to recognize the loan losses, right? Yeah. And so the banks just, instead of foreclosing, the banks could just like extend the loans out and pretend the borrowers were going to pay it. And so the result is that the pricing never went into the kind of free fall that it did with the RTC in the mid 90s. Yeah. And so the result of that was that even the professionals who were not hurting from the mistakes that they had made, the ones who had access to capital and absolutely could have gone on a buying tear, didn't, because they kept waiting for things to get better, for prices to get even lower. And we didn't know anything about the RTC. We didn't know anything about anything, but it was just like, okay, well, here's the rent we can,
like, let's go get it.
Yeah. It was like, here's the rent we can get for these units. Here's what it's going to cost to buy the building. Seems like a good deal. Let's buy it.
Yeah.
And so it was very fortuitous. It was that kind of like beginner mindset and naivete, honestly, that allowed us to kind of jump in when everyone else was running away.
That's wild. That's super cool. It's interesting how a lack of knowledge maybe was your edge, at least behaviorally.
No, I mean, even with that, the second building, so the first building that my friend capitalized, so our second deal, when we were finishing the renovations on the first couple of units, we went around and we interviewed other management companies. Okay. And we were like, these are the rents that we want to get. And the management companies were like, you guys are out of your minds. Like, in other words, it was the same beginner thing. Again, we were just looking at what was available on Craigslist. We were like, our units are way better than that. This is a cool neighborhood. Like, people are going to be willing to pay this rent. But the management companies couldn't see it because they were used to dealing with their own shitty units, which would never have got those rents. Yeah. So when we said we want these rents, they were like, forget it. So we were like forced to do the leasing ourselves, basically. And we got the rents. And it was like, oh, okay. Like, no one else knows anything. Like, you can just look at the market and figure out what the rent should be.
Yeah. That's wild. So have you stayed in pretty much the same asset class? Do you focus on a neighborhood? Like, how's your career gone? It seems like it's mostly the same asset class.
It's basically, I mean, we did some single family flips in that first batch of deals that my friend capitalized. And that, just to be really clear, that first batch of deals was under a company called Better Dwellings. So within Better Dwellings, within that initial portfolio with my buddy, I think we did like 2 or 3 single family home flips, some small apartment buildings, and then some bigger ones.
Yeah.
It's funny. We sold the single family homes and the small apartment buildings, and then we actually sold the big apartment buildings too. And my big takeaway from the whole thing, I remember, like, conceptually, I understood that selling real estate cost money, but I remember looking, it was actually a very interesting experience. So we sold everything. We very stupidly liquidated that entire initial portfolio in like 2012. Very stupid. Like, we should have.
Why?
My buddy was kind of like, look, I've been your training wheels for a long time. Like, you guys need to build a business. And, you know,
that's kind of cool of them, though. It pushes you in a uncomfortable direction that ends up helping you long term.
Totally. But it is a big lesson I learned. And it's one that is absolutely relevant to, I think, anyone who's in a professional money management business is think long and hard before you become overly reliant on any one capital partner. Like, because that person can just get out of bed one day and be like, you know what, actually, not interested anymore. And if you haven't developed the fundraising muscle and the network to go out and raise capital from other people, your career can kind of like come to an end for reasons that have nothing to do with your skill in investing.
Yeah, that makes sense.
So he was kind of like, look, like, I want my money back. Like, and we had done pretty well. So we sold everything. And then I remember there were a couple of like really key insights that came from that experience of selling. So the first one was, I knew before that intellectually that you could buy a building and fix it up and then have the building be worth considerably more than you spent to do that. Like, we can go through the math, but basically, like, let's say, just to go back to our like unlevered yield example, like, if you create a 7% unlevered yield, like you invest $1 million and it's generating $70K in net operating income, and it's a 5 cap market where people are willing to buy at prices that reflect a 5% yield, the building is worth 70,000 divided by 0.05, which is more than $1 million. I don't know what it is off the top of my head. And that delta is your profit. I mean, it sounds very obvious. And so conceptually, I knew that, but it's like a different thing to actually sell the buildings. And you're like, someone came along, we like hired a broker and he advertised, and a random person came along and was like, this building that you invested $2 million in is worth $2.8 million. And here you go. And okay. So that was awesome. I know it sounds like kind of lame. Like, it's like,
it doesn't sound lame to me, man. I'm sitting here thinking the exact same thing happened to me, and real estate is what helped me capture it. I have an LP interest in a fund that targets cities. So it's apartment complexes. And they target cities that have tech inflows. So like our general exposure is some San Fran, not much because the cap rates are so tight. Austin, Denver, we have some stuff in LA, Seattle. And I didn't really understand how it all worked until we were walking one of the properties. And my buddy said, he walked me into the common area, right? This is a place in Denver. He's like, okay, so we're going to invest this much in the common area. We're going to pull the leasing offices to the front. We're going to make it like approachable. We're going to put amenities in here. We're going to invest in the pool. And then it's going to raise the value of all of our rents. And then we're going to capitalize that. And this is how the math works. And I was just like, holy crap. And it's silly to say because this is back in the day when I was like, oh, deep value is the only investing strategy. And I'm looking for 50-cent dollars. And then I started to think about, okay, well, if you can do that in real estate, what can you do in companies? And if I can figure out like how much more earnings this company is going to have in 5 years and then put a multiple on that, I'm sure people are listening like, how did you not understand that? Well, the answer is I didn't, but I do now. So I'm less dumb than I used to be.
Well, no, but it's just a different thing. Like it's such a simple observation or a simple understanding. But like for me, I think maybe if I had been from a more commercial family, it's like, I think if your family owns a little business, right? Like a store, let's say, right?
Yeah.
And they like buy wholesale and sell retail. You're like very used to the concept that you can buy something for $1 and sell it for $2. It's part of the life of your family. Okay.
Yeah.
Our family, we owned some buildings, but we weren't that commercial. Like, I guess maybe I had a lemonade stand once or something, but like, I wasn't one of these like budding entrepreneur types who like goes and, whatever. Like I didn't do that. I was interested in history and reading and all kinds of other stuff. So it really,
when your dad was into art, right? And you said your mom worked for what?
New York State government. Yeah. They were a bit small. They owned some real estate, they're not naive, but they're just that money is not like the focus of their lives.
Yeah. That makes sense.
It was really not until we sold that first building from that pool from Better Dwellings that we did with my friend that it was like, okay, this actually works. It's not just like a theory that you read in a book. Like some random person will come out and write a check. Okay. Very helpful. But then the following realizations came immediately thereafter. One, if you look at the closing statement from a sale of real estate, what you see is a shitload of the gross purchase price gets vaporized in transaction costs.
Yeah, your fees are just garbage.
There's brokers, there's city and county transfer taxes, escrow, title, like you name it, just like, and it's...
Yeah, it's just a ton of leakage.
Yeah. On a deal in LA, you're probably talking like, depending on how much you negotiate the brokerage commission, you're probably talking like 7% of the gross sale price leaks out.
People then don't think about, okay, well, this is an 80% or 60% or whatever levered asset. So as a percentage of your equity slug, the fees are huge.
Huge. And then, okay, so you kind of sell and you're like, ugh, all right, but at least I got my money, right? I guess at least I got the net proceeds. But then you file the tax return for the entity and you realize that between federal and state taxes on your capital gains, you're vaporizing another big chunk of the remaining equity. And that experience of selling that whole portfolio in like 2012. One more thing. Then, okay, so we sell this thing, get killed on the transaction costs, get killed on the taxes. And then to add insult to injury, we have to watch as the rents keep running and therefore the values of the buildings keep running. So we sold stuff in 2012 to people who bought it from us and then just basically like did no work, just sold it on again a year later and like made more money from holding it for a year and reselling it than we made from doing all the hard work of renovating the building.
Brutal.
Yeah. And so taken together, the experience of selling a bunch of stuff and just vaporizing a bunch of value and then watching as the values of those sold buildings continued to soar really drove home to me that selling real estate, that if you have good renovated or new real estate in improving areas in a good city, like don't sell that.
Yeah.
And then the more that I sort of started reading about it and thinking about it and meeting people and everything, it's like, we never sold the first building we bought, like the one we own with my family. Like we still own that building, however many years it is later. We've refinanced it and we've pulled way more than the original equity that we invested out. It's worth more than double what we bought it for. And it's still chunking out cash every month. And it's just like, when you have assets like that, like don't sell them, like hold them, manage them well, take care of them and refinance them and pull the capital out tax-free and buy more. Like, so that experience of being forced by my buddy to liquidate that original portfolio really ended up being the impetus for the strategy that we still follow at Adaptive Realty. So we sold that whole portfolio. My brother and I decided to stop working together. It was just like too crazy. We had an employee and kind of a junior partner at that time, this guy, John, who had been working for us. And then I decided to go, by this point I had a young child. I was married. I had a young kid. We didn't really have any money because we didn't really make that much. Like my friend did okay on the sale, but like we did okay, but not great. And I'm sitting there and going, it's like, we're in the middle of it's still 2012. It's like not a great time to get a job. I have a young kid. The only thing I know how to do is I've got my brokerage license because I like had been representing us sometimes in buying buildings. My buddy John had got his contractor's license. And so all we knew how to do was do what we had been doing, which is buying and fixing up apartment buildings. So we went into business together. That was the formation of Adaptive Realty. So John is my
That's
full
cool.
partner.
And that's your partner that you're still with?
Yeah. So I do
That's cool.
Yeah. So I raise the capital and I find it and buy the buildings. And John does all of the design and construction management. And it's just,
he does nice stuff.
He's great. He's not like trained as an architect or anything, but he has good taste and he has extraordinarily good spatial reasoning skills. We've renovated 100 buildings over the last 12 years. Wow. And he has laid out more small apartments in Los Angeles. I bet there aren't architects he sits there with like a paper and pen and like moves walls. And it's always like a game of Tetris because you're trying to like optimize the space usage. And he's just really good at it. And not only good at doing one building, but like doing 10 of them at a time. Imagine overseeing 10 gut renovations of different idiosyncratic apartment buildings at once with different contractors and different neighborhoods. It is a monumental logistical and operational challenge. And he's really good at it. And so, so it's been a very fruitful partnership in that way.
That's cool. It's nice to find somebody that complements your skill set.
The other thing to say, and this is maybe a little bit more subtle, is my background pre-real estate was in banking. I did a couple of years of like M&A banking, and I went to Princeton. I like to read a lot. Like I'm not a hands dirty kind of guy. Anyone who knows me who's listening to this is laughing right now because like I'm the opposite of a hands dirty kind of guy. Like I like to think about things and read and everything. Okay. John grew up in a family without any money, and his parents wouldn't help him pay for college. They couldn't. His stepfather loaned him enough money to buy a truck, and he bought one of those like College Pro house painting franchises.
Oh, like, yeah.
And he literally put him.
Pro.
Yeah, he put himself through college. Every summer, he would run painting crews in New England, hire a bunch of initially kids, but then eventually it was like grown men, and like go around and quote and like as like real small business, hands dirty, working with blue collar guys. And he was really good at it. And so he is just a scrappy person. He's not particularly interested in, I mean, I guess he could probably explain what a cap rate is. Like, it's not like he's not an idiot. He went to Wesleyan. He's a smart dude.
Yeah.
But he's not like he doesn't read books about real estate. But what he does is know how to run construction projects. And he's got like a kind of a small business mentality about like just being scrappy. Like, we're going to figure out how to get this done. We need to do more, figure out how to say yes when someone wants to do a project. We'll figure it out. Like that urgency and drive. And so the combination of that, he really taught me a lot about being scrappy. So it's not just like the intellectual and the looking at the deals and the running money, but it's also like almost like more of a mindset thing. It was incredibly valuable for us. And I mean, we built an asset management business from 0 assets under management. We're at like 155 million or something now, and like growing really fast. But growing something like that from 0 with no fees and no nothing coming the door and none of your own capital, like that is, or very little of your own capital, that is really hard. And we absolutely I would not have been able to do it on my own. It was John's like scrappiness.
Yeah. That's cool. Those college pro guys are scrappy.
Yeah, he was climbing up on roofs and like getting in fights with, New Hampshire homeowners who like wanted him to come back and paint it again. And like, that is completely beyond my experience of the world. Like I was like hanging out at fraternity parties at Princeton then, you know what I mean? It's just a completely different experience.
Yeah. The painting crews are a different level of sort of, I don't want to say like unreliable, but that's the word that's coming into my head. I have interacted with a lot of those college pro guys, and the stories they have are pretty funny.
So what happened with John is after a few years of doing the conventional college pro thing, the college pro company came to him and were like, listen, our problem is that we hire all these kids in the summer and they fuck the jobs up. And we need someone to go around and fix the jobs after they fuck them up. And so he stopped having to like go bid new jobs. The company would just pay him to go fix the jobs that the other people had screwed up all over New England, like in August and September. So he was like sleeping in his pickup, driving from Wesleyan in Connecticut up to New Hampshire, sleeping in his pickup truck for the weekend. I mean, really crazy stuff.
Huh. That's cool. So did you guys know each other from back in the day? Or did you meet like just by happenstance?
He went to college with my brother.
All right.
So it was,
and then what was he part of the? Were
he
you,
was our
your brother, and him all three in the business together?
Yeah, he was initially our employee, and then we made him a very, very junior partner. So by the time, that was the other thing, like by the time that he and I founded Adaptive together, he had renovated 13 buildings or something. I mean, I had been working with him for years, and I knew that he was great. So it wasn't like, it was a very sort of organic way to start a partnership.
And then when you founded Adaptive, did you go out and try to get one building and then raise the funds, or did you try to raise like a fund first to then close on a building quickly?
So
I know that's, yeah.
So it was crazy. I mean,
it's a huge competitive advantage closing, isn't it?
It is, but it's also very much harder to raise a fund than it is to raise it for an individual deal. Because you have to go to people and be like, I would like to raise money to buy some buildings. They'd be like, what's buildings? And you're like, I don't know. So
yeah. And I need your capital for a time period.
Yeah, it's very hard. And we didn't have that much of a track. I mean, we had a little bit of a track record, but I mean, it was still crazy to try to raise a fund then. But we did it, and it was tiny. So I went out, I made a list of all of the rich people that I knew. And this included like parents of friends. I didn't grow up going to like country clubs or whatever. Like the list wasn't that long. So I was able to get, I think I got $1.8 million worth of commitments, which is like for a fund is like ridiculously small. And then I asked kind of a last ditch effort, I asked our CPA if he knew anyone who might want to invest. And he was like, well, there's this family, like you should go meet them and like, just tell them what you do and we'll see what happens. So I go to this office in Santa Monica. I was so green, like I dressed up. It's funny because I know these guys now and I can visualize now what I must have looked like to them then and like how they were so nice to me, but I was so green. So I go in there and I meet the like senior non-family member and I explain to him what we do. And he's like, okay, like if you just want a couple $100,000, I'll write you a check right now. Okay. But if you want a material amount of money, we're going to have to negotiate the docs. And I'm like, what's material? And he's like, well, we'll match what everyone else has contributed. So I was like, okay, and it turned out that the negotiation that they wanted to do was not, they didn't want to come after our money. It wasn't about the economics. They wanted some control rights. They wanted to be able to veto deals, basically. That seemed reasonable.
To approve them? Like, did they want to just make sure that you were doing something that made sense?
Yeah, exactly. And I was a little worried at the time going back to the other investors and saying, look, we brought in this big family and they're going to have veto rights. But as I started talking to the other people who had signed up, it occurred to me that having the whole thing blessed by this like huge real estate family office, and these guys own an incredible amount of assets. They've been doing real estate in California for generations. I mean, they're huge. And so having them come in and take half the fund is like an incredible endorsement of what we were doing. And having them have veto rights over the deals, far from being like something that's bad for the other investors, is actually great for the other investors. Like the other investors are thrilled to have these experts reviewing everything. So it was very easy. The other people were like, great, like, fantastic. And that was Adaptive Realty Fund 1 was, I think it was like $3.6 million, half from close friends and family and half from this family office.
Huh. That's cool. That's a good way to start. So if I had told you then that you'd be here now, how many seeds of doubt did you have to get over before you got to where you're at?
Oh, I mean, I remember distinctly being like, God, if we could get to 100 million of assets under management, at this point, we probably had like 12 million or something. I remember thinking, God, if we could just get to 100. And then I remember waking up like a few years later, and I think we were like doing a personal financial statement or something for a bank as part of a refi. And the bookkeeper, like we have an awesome bookkeeper and she's been with us since the beginning. And she like totals it all up and it's like, these buildings are worth more than $100 million. And it's just like, what the fuck? Like it just sort of happened. It was just like, and it's like, you just keep. So I had doubt all the way through. I mean, we were broke. We did a $3.6 million fund is not enough for people to live. I mean, we had an employee, so we were brokering, we were doing property management, we did tons of fee development. We scraped and clawed to survive as we grew the business. It was in retrospect, an extraordinarily difficult time in my life. Like from when we founded Adaptive in 2012 through about like, things got easier probably in like 2016 or something. But that first period was brutal. We were a subscale asset management business with a subscale property management business stapled to it. And then a subscale brokerage that we started. I mean, it was just like, it was really hard.
Yeah, that's wild. And you had a kid at home, right? So
and then a second one.
Not the easiest thing to deal with.
No, it was terrible.
Yeah.
And I mean, cards on the table, and I don't really want to talk too much about it, but like, you know, my first wife and I got divorced. It was not just because of the money, but like it was
Jeez.
And I was really rough on her, and I was extremely rough on John, my partner. Like I was so consumed. There's a couple things going on. One is my friends from high school, including the guy who had staked us to our first deals, did incredibly well. Like early in I have friends who like retired in their 30s. Like my friends had done so well. And I'm here like running this shitty little real estate business, and I'm like broke and driving my mom's old car that she gave me, going to real estate conferences and like my mom's old blue Audi, and it's dirty because I haven't washed it. And I'm trying to make sure that people don't see me leaving the conference because like I'm trying to present myself as like this real estate expert, and I'm like getting in a shitty car.
Yeah, and then you get in that car.
Yeah. It was terrible. I felt bad about myself. I was envious of my friends. I was consumed with this like drive to try to make it. And I put an enormous amount of strain on the relationships with people who loved me and were around me and trying to help me. I was just like a complete stress ball lunatic. It's like the classic, like allowing your net worth to like be the center of your identity or whatever. Like it was just, but that rage and anxiety and whatever, like kind of drove everything forward. And then by like 2016 or so, 2017, the flywheel starts to spin, and we have more and more investors and more deals, and the company's grown and it's not so subscale anymore. And then it got easier, and I learned a lot about how to be like a normal person. I don't know that my wife, my current wife, would agree that I've quite got there yet, but
well, mine wouldn't think that I am at all. And I don't think I am. I don't think I actually want to be.
Yeah. No, I mean,
I think that's interesting. I come from a way different place. I have not struggled financially, but I've had like family and personal stuff that has been sort of the card that I was dealt that wasn't super easy to deal with. You know, as a kid, saw some stuff that I probably shouldn't have. And for a while, it manifested itself in me by acting out in class a little bit. And then I sort of got behind in some of the classes, and then I was sort of told that I was stupid, and I always sort of ran from this fear of like, yeah, I have this money, but, and I mean, it's not like a ton, right? But I'm also blessed at the same time, so I'm not trying to, but I had like this shame of like feeling that I wasn't worthy of it, right? And then when I didn't do well in class, and then I had kids or friends that I felt like sort of, you know how guys will like pick on each other's insecurity. Like they knew that was sort of the button that they could go at, and it like manifested itself. And man, I lived with that shit for a long time. And honestly, last year was probably the year that I kicked all that stuff, because I don't know. I just,
did you
I
have
feel
help?
like I became a man.
Did you have help?
Oh man, I've done a lot of therapy.
Me too.
A lot.
Me too. Yeah. I mean, not in two different chunks in my life, and both times were extremely helpful. Like
I've gone to men's groups. I've screamed at a chair. I've done all kinds of weird shit. But you know what? I needed it, and it brought me through. But it definitely stunted me, or I let it, or whatever the hell. I don't know what the answer is. But,
can I ask you, how much of the improvement do you think comes from the work that you did, and how much comes from just like maturing, just getting older and like more fully inhabiting yourself?
I think that it's probably, I guess I don't know how to untangle those two things.
Yeah, it's a hard question.
And I think the reason it's hard is I don't know, like I spent a lot of time on a couch as a kid, but as a kid, I wasn't really willing to hear the conversation that was going on, right? Like my brain couldn't really comprehend what was happening. And then I had a situation with my dad that I feel sort of bad talking about it, but I also think it's really important. I had to check him into a hospital, and he was going through actually a divorce in his life. And it manifested, like what that did to him was he like didn't sleep, and he totally abused caffeine, and then it started to go to Red Bull. And then like, it was like 30 days. I think he only slept. I mean, he slept under 30 hours in 30 days and like he just lost it. And after that, I called the man and I sort of apologized for what I thought my dad's behavior was. I don't know what's reality and what's not because I wasn't in the room. And he said, you know, why don't you come to this group that I'm involved in? And at the time I was probably 28-ish. And I think that's when I was really actually ready to start to receive some of the messages and do some of the work that was really like required. And, you know, I don't know, for me, it's hard for me because I like love Buffett and Munger, and I don't think that they would approve of all the media that I do, right? And you're not learning when you're talking. But the other side of it is like I left a job and I didn't want to disappear, and I have not disappeared, right? And I think I get a lot of encouragement from people, and it's fulfilling to me, and it's manifested itself in ways that have made me money, and I'm trying to reciprocate and stuff. And it's just sort of I don't know, man, it took a long time, but finally I'm like, you know what, I am worthy of this. So I finally feel like I could look at the guy that I sort of owe all of it to and he'd be proud of me, but it took a long time.
Yeah, no, I mean, I think people don't, obviously there are taboos about talking about this stuff. And one of the things that, I mean, I participate in Twitter and do podcasts and stuff because there's material benefit to me, right? Like I've met a bunch of capital providers. So like, there's no question that it's like helped my career in that way. But I'm not raising money for anything right now. And the reason that I do this is that I didn't have a mentor going through that process of building a firm. I had investors who were pretty experienced, but like when they're your investors, there's like a little bit of a, like, you can't be totally honest. I mean, maybe honest is the wrong word. You can't be raw because like, if you're too raw, they're going to be like, whoa, like, you know what I mean? So, and I actually, with our biggest investor, I remember being like, look, I'm getting divorced from my wife. And that was like a big moment to have to tell them that and everything. But my point is that I do this stuff to a large extent because I didn't have that mentorship and I didn't have anyone kind of like telling me how this works and like helping me avoid mistakes and all that stuff. And so a big part of this for me is just like trying to be that mentor for people who are who are 3, 4, 10 years behind me on that journey.
Yeah. Well, I appreciate you doing it because I'm learning stuff too. You know, I guess that's sort of how I've approached it as well. Is I didn't grow up around people that were money smart. I grew up around people that thought that money would sort of just always be there. And I love my family members, but like I think that if they want to argue that point with me, we can go toe to toe on that one. And like I watched, you know, my one uncle drank himself to death at like 41, and my other uncle took a long, long time before he got himself sober and a productive member of society. And I don't know, man, like for a long time, I just sort of wish that I could find somebody. And part of the reason that I have so much love for Buffett and Munger is like, those are actually the guys that I learned from. I know it may sound really weird, but like, I don't think I'd be a man without them. So I don't know. And then I sort of got involved in Twitter, and the friends that I've made and like the true connections that I've gotten from that, it's been unbelievable. And a lot of them have been featured on this podcast and will be in the future. And I'm just trying to live, what does Naval say? Wealth games, not status games. And it's worked out well. Yeah,
no, amen. Amen.
The mental health part I'm particularly passionate about because I just think it's total bullshit that people feel like they have to hide from it or whatever. And the amount of stress that you go through trying to build stuff is crazy.
Totally. Yeah. I mean, I think that in some ways the personality type that wants to go build something from scratch is often, very often, the kind of personality type that puts a ton of pressure on him or herself and also the people around them. And it's like, that's exactly the person who needs some help and support and needs to know like how to take care of him or herself. It's a really hard, lonely road unless, I mean, obviously if you have a dad in the business and they help you or you're spinning off of a fund and you come out fully capitalized or something, it's a different story. But if you're trying to build something literally from scratch, like it's just a long, lonely road.
Yeah. Yeah, no doubt. I think that the other thing that's tough is, you know, everybody that at least I studied when I was younger, right? You sort of look up to the people that have done it. And it's like you're comparing yourself to the Tom Brady's of the world. Like you're still in high school Pee Wee League, right? It's like, no, man, you got to put the reps in.
Yeah, no, I mean, For me,
That's
like
interesting.
having my best friend basically shoot the moon in our like, I guess, late 20s, early 30s. It's like, imagine that, like, right? Like this is a guy who I've been close with since we were 15. I mean, he's a really smart dude. So like, we're not in the same league intellectually, but still like, this is someone who like, I think of as a peer who just like goes out and fucking blows the doors off and like is done by early 30s. And I'm like 31 and like have, you know, $1,000 in my checking account and a young kid. And it just the anger and the jealousy. But the thing is that like, and this is, I think, another lesson that's important for people to understand is he was putting the reps in high school and in college. He was taking like serious physics classes and math and everything. And he worked really hard out of college. And I was in a fraternity. I was drinking. I was smoking pot. I was like a little bit lost. I was like a banker, but I didn't really know what I did. I basically screwed around for a lot of my 20s. And it turns out that like, as with everything else, like things compound. So if you start killing yourself in high school and college and you continue doing it through your 20s, you set yourself up for this life where like by the time you're entering your 30s, you are in a pretty amazing position professionally. I didn't do that. I kind of messed around and kind of caught one of the last trains in my late 20s. Like my first real estate deal, I think I was 27 or 28, maybe 28.
So we were talking about your friend that shot the moon out.
Yeah.
That happened to me as well. It was interesting to watch.
Yeah, I mean, he handled it incredibly well. I mean, basically he ended up setting up a whole bunch of us in business. Like in addition to what he did for me, he also like angel invested in one guy's tech company that did well and started another company with another friend. And God knows, probably did the same thing for a bunch of other people too. So his success sort of really allowed a lot of us to get our start, maybe not just get our start, but maybe like accelerate our careers in ways that would not have been possible otherwise.
That's cool.
Yeah.
Does that like make you want to do it for somebody else, I guess? I'm not trying to like, yeah.
Oh yeah, of course. I mean, it's going to be a while before, I mean, part of the thing about not selling is that we're just not that liquid anytime.
Yeah.
What we've done is created this machine for tax efficiently growing net worth.
Yeah.
And the machine is going and it's gone pretty well and it's going to continue to do well and everything, but it doesn't result in like huge chunks of cash.
Yeah.
Like I'm not in a position to like write a $10 million check for someone's, for someone's startup or whatever. But it's definitely influenced my desire to mentor people and have interns and help people I meet through Twitter and that kind of stuff.
Well, I think one thing that you can do if you're not going to cut a check, right? Which I think a lot of people can. I don't think there are that many people that are willing to come on a program like this and be raw. And I think that's the way that you can help a lot more people than the check, right? Because I don't know. I think money is, it's a weird thing to say out loud because I don't actually think it's a pretty abundant commodity, but I think that like true mentorship is much more scarce than dollars.
Well, particularly now, I mean, the world is awash in capital.
It's
like there's capital coming out of everyone's ears right now.
Yeah. What has it done to your business? I mean, are you seeing deals that are interesting at all right now, or are you just sort of sitting on your hands?
I mean, it's a mix.
Obviously, you never just sit, but I mean, like...
No, we're looking for stuff all the time.
Yeah.
We have a couple of different pots of money that we invest out of, and the fund that we just raised in the fall, we can't find anything that makes sense for that right now.
Yeah.
It has very strict quantitative targets. Like, we're not missing by a little bit, we're missing by like a lot. And so we look every day, we make lowball offers sometimes. We're trying to make things work, but it's just not working right now. We have an opportunity zone vehicle.
Oh. That'd be cool.
Yeah, it's like the same. It's actually funny. It's a guy who I met through Twitter, honestly, who wrote a very large check. He knew very well a guy who has been an LP of ours for a long time. It was a serendipitous meeting on Twitter, but it was not wholly unconnected. Like, so there was.
Well, that's how the world works, right?
Yeah. So we have a pretty big opportunity zone allocation. We've done, I think 3 deals through that. And that one, we can accept lower returns for those deals, obviously, because of the tax benefits. So we've done a few of those. Those deals are closer to working right now than the fund deals are.
Well, that's what it's designed to do, right?
Mm-hmm. Yep.
So hopefully it spurs the investment and the innovation in those communities that can create the opportunity.
Yeah, I mean, literally the last one we bought, which I think we bought a month ago or something, is literally like a building in a pretty good area that happens to be an opportunity zone. And it's just like, it was effectively like derelict.
Wow.
And it's a great building, but it's going to cost a hell of a lot of money to return it to use. And it would not have made, given where construction prices and rents are right now, it absolutely would not have made sense if it weren't for the tax benefit.
I know it's, we're talking about finance, so the money matters, but what a rewarding experience to be able to do that in a zone that needs the investment. Yeah. That's really cool. I make fun of ESG a lot. I don't actually mean that I don't believe in like making a difference with your money. I just don't believe in public market ESG, mostly because I don't trust the people marketing it. But like to do it with your own dollars, that's something I could totally get down with.
This gets into like some political stuff about like, well, Los Angeles has rent control. And there's this question about like, are you raising rents and therefore chasing people out of their own neighborhoods? There's a lot of validity to those arguments. But one thing I'll say is that the majority of the housing stock in Los Angeles is really old. Like the city was developed kind of in the teens and the 20s, and a lot of those 20s buildings are still there. And like, there's also a lot of 60s stuff. We are way past the useful life of those buildings. And they need everything. They need new plumbing, electric, windows. There's lead paint in them. Some of them have asbestos. Like they are not safe places for people to live to a large extent. And so whatever you think of the politics around like, fixing up old buildings and raising the rent, which is sort of what we do, the housing stock in Los Angeles is just unhealthy and requires investment. And like that investment needs to get a return. Otherwise it will not happen. Yeah. And so like, I'm not going to sit here and claim that it's ESG or something. I mean, I'm just a dumb real estate guy, but you just have thousands of apartments that are not safe and become safe once we gut them and replace everything and put in modern insulation and energy efficient appliances and water fixtures and everything. Just like we're making them into places that will be safe for people to live for 50 or 100 years going forward.
I'm bidding out building a home right now.
I saw that tweet. Yeah.
Dude, what I have realized is like stuff here trades so far below replacement cost because replacement cost is so high. Like it's crazy.
Yep. I think that's actually, it's a very interesting observation that you made. And I think it's not widely appreciated. So first of all, you can see it in everyone in the multifamily space right now is like obsessed with the fact that insurance quotes are going up. Everyone's like, the insurance quotes are going crazy. Like keeps ruining my pro formas. The reason the insurance quotes are going up is because the construction cost of repairing things that break is really way higher than the insurance companies had been previously underwriting. So that's like a kind of a symptom of it.
Is that a material issue or a labor issue? It's a material issue, right?
Both. Yeah. It's material, but it's also like there's a lot of the boomer subcontractors and contractors have kind of like are aging out of the business.
Yes. And a scarcity of labor.
Yeah. Well, and then on the labor side, there used to be pretty lax border enforcement. So what would happen when there was a building boom is like a lot of skilled workers would come over from Mexico and Central America. And it's got tougher to cross the border. And also there's just better economic opportunities, particularly in Mexico now. Like you can make a good living in Mexico. So these guys, like, they're just like, I don't really need to go take my chances with ICE and everything. So the guys running the little companies, the contractors and subs are kind of aging out and retiring, but also the guys who work for them are not being replaced by young people coming in.
Yeah.
So labor's gone through the roof and materials.
Huh. That's wild. It's probably a combination of 4 years of policy and COVID, right? All sort of hitting together at the same time.
And the Mexican economy improving. I mean, I don't know what it's like today, but like over the last like 20 years or whatever, it's just got like you could have a better life like staying and working in Mexico than you used to be able to.
Yeah.
But the interesting thing is, so when you start to really think about the rapid escalation of construction costs, it starts to become a barrier to entry. So like for any given piece of existing real estate that you own, you're kind of like worried as an owner, is someone going to come and compete with me by building a building next door?
Yeah.
Okay, or around the corner.
Yeah.
And
now they almost can't.
Yeah. With construction pricing escalating 10% a year or whatever, way in excess of rent growth. It's just like, even with low interest rates, it becomes harder and harder to justify building anything. And so at least in places like Los Angeles, where there's high barriers to entry anyway, and there's a lot of demand, you get this situation where there's a lot of people who want to live here, but you still can't make the numbers work on construction to build more stuff. And so it's going to have the effect of shooting the rents up. That's partially a zoning issue. We have crazy zoning here, and that's a whole other conversation, but it's also increasingly a construction cost issue. I mean, there's some advances in modular construction and stuff that might start to change that. But right now, man, I'll give you just an anecdote. there's a pair of partners who are sort of contemporaries of mine. And in the same neighborhood that we do our rehab projects, they do ground up. They're like smart and scrappy, and they do their own GC, and they're good at what they do. And they can't build anything now. Then they really haven't been able to build anything for a couple of years. They're just, the numbers just don't make sense. And they couldn't get cheaper prices. They are the guys who should be able to build in any market, and they cannot build. I think that is a very, very good sign for existing owners of apartment buildings, because it just means that there's going to be less supply.
Yeah. And arguably homes, I guess.
Oh,
I don't know, but then you get into an affordability issue, right? Where it's just like, well, how are you going to increase supply? Because you can't.
Yeah. I mean, I think Los Angeles is a weird market in that there's a lot of people who make money in other places who come to Los Angeles.
Yeah.
So we're like, and even if they themselves didn't make money, it'll be like a lot of our tenants, they'll be like graphic designers or whatever. They're doing okay, but it's like their parents are co-signing on the lease for them. Yeah. And the parents making $500K in Cleveland or something, but the kid wants to live in LA and the parents can afford it. So the parents just chip in on the rent. The affordability metrics that people use, they want to compare what the rents are to median incomes.
But that's not really what's going on anyway, right?
Yeah, you just have all these people who are like making money, like I said, in Cleveland or wherever, who are subsidizing their kids. And so it doesn't show up in the median income statistics, but they can pay the rents.
Yeah. Man, I don't know when it's ever been like easy to look forward and be like, oh, America's set up and everything's great. But it feels like it's going to be really hard coming out of COVID for the wealth gap to close a little bit.
I mean, I have my reservations about the like work from home, remote work stuff. Like it has not been great for our company, but I know that other people have done really well with it and whatever. I think the most positive thing probably to come out of COVID is the realization that at least for some companies that you can do business remotely means that a bunch of jobs and wealth creation will sort of like get redistributed back, not just in San Francisco and New York and LA, but like, other cities and states will benefit too. That's both good for individual people because it's more affordable and whatever, but it's also just like good for the country. Like it's totally fucked up that we have this like winners and losers thing and the country's so bifurcated and it's just not good.
Yeah.
You want to have people who can live in a small town and make a good living and raise their kids there and everything. And I think work from home has the potential to do that.
Yeah. I mean, I've talked about it before on a previous episode, but my mom is looking to buy somewhere around here too. And like, I don't know, it's tough. It's like you might need to rent. I don't know what to tell you. Like the cost is just really, really high. And if you're trying to live off what you have, like to buy doesn't really make a ton of sense. Might be time to cash out the equity on in the real estate portion.
Yeah, man. I mean, starter homes in LA, like in LA proper, like not the Valley, starter homes, like 1.2.
Yeah, that's crazy.
1.3. Yeah, it's nuts. It's nuts. No one can, and it's kind of amazing for us because no one can afford, obviously there are people with family money whose parents help them with the down payment and then that's how they do it. But there's a whole group of people who are successful, hardworking, people who are doing great in their careers. They're responsible and they want to live in a cool neighborhood in LA, but they just haven't saved up the $400,000 that they need for a down payment on a place that they would like to buy.
Yeah.
And those people are awesome tenants. Like if you make a really nice apartment for them, they are happy to pay really high rent. They're making, they're making $150K or whatever. It's just like an insanely good tenant demographic. But again, not great for the world. Like you want, from a societal perspective, you want people to be able to see how they can like buy a house and raise a family and all that stuff.
Yeah, I guess like it would be one thing if I had the answer where I was like, well, stocks are really cheap. So if they can rent and they can invest, then they'll make a lot in the stock market. But then I look at stock market valuations and I'm like, well, I can't confidently tell you that returns haven't been pulled forward a lot there. So if you get the combination of I can't afford my house and I can't make money elsewhere, which, maybe that's not true. Maybe stocks aren't that expensive, but boy, it doesn't feel that way to me.
I mean, let me know when you find the answer to this problem because I certainly don't know what it is.
Yeah, that's right. I don't think the answer is trading GameStop or whatever. I don't think is the answer. So
there you go. We just timestamped the episode right there. Again.
That's exactly right. Yeah, it may not season very well. I don't know, man. I got to get going here, but I've had just a fantastic time talking to you. I hope you come back. I'll have you back on whenever you want, man. It's been great.
Likewise, I really enjoyed it, and I've never. I'm going to have to go drink some water or something. I've never talked for this long in my life, but I hope I haven't put everyone.
We didn't even
to sleep.
take a bathroom break.
I hope people have enjoyed it, and I appreciate what you're doing. I think it's really cool, and I look forward to connecting with you and other people on Twitter and everything.
Yeah, how can people find you?
Just at Moses Kagan, all one word, and you'll be bored to tears by my incessant real estate chatter.
I don't think so. I think it's pretty good stuff, man. I enjoy it.
Thank you. I appreciate that. Thank
you very much, and we'll talk soon.
Thanks, man.